Thanks for joining us on lunch. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Ira Duggal. These are our headlines. Indian markets trade lower for a third straight session. The Nifty hovering around its 50-day moving average.
Sun Pharma is among the top Nifty losers today after the company fails to give a clear timeline on when it hopes to resolve regulatory issues at its Halol plant.
Lupin is also trading more than 1% lower. Details of an FDA letter which emerged last evening show that the regulator warned the company of repeatedly ignoring quality standards.
Tata Steel, Piramal Group and Edelweiss ARC are likely to submit final resolution plans for Electrosteels. That's a Bloomberg Quint exclusive.
Coming up on the show, a couple of conversations. The regulatory hurdles in the pharma sector refuse to die down. Sujesh Shetty of PwC India gives us his views. And Gartner India expects a healthy growth in domestic IT spending. We understand the rationale from Ganesh Ramamurthy.
But first, let's take a closer look at how the stocks are moving today. Neeraj is here with his views. Neeraj, what's going on?
It's a repeat, right? Every day we have the same thing. We are down about a third of a percent or 0.5%. Today is no different either. But I must say today the global markets are also subdued. So while we did start off on a poor note, I think it just looked at the Dow futures before I came in and they are pointing towards a bit of a downtick. European markets aren't exactly setting the stage on fire. So the global markets seem to be a bit sluggish in the session today. Looking at our markets, there are some select short positions that are being built on key indices as well, including the index. If you look at the call put data as well, that will kind of suggest that some bit of negative trading positions are being built, which is interesting, but the volumes are fairly tepid. The volumes aren't really gung-ho. And commodities have corrected. Commodity stocks are correcting. Amongst the top losers are companies like Vedanta, Hindalco, and a few others. Now, the only thing that is a bit of a bounce today is OMCs. I'm just trying to figure out what, aside of the fact that they were oversold, could be working. One, of course, crude prices have retreated. They fell overnight 2.5% and they've been coming off 3 out of the last 5 days. That may be working in the favor. There's also a technical factor here. BPCL and IOC feature in the Bharat 22 ETF. The anchor book worth 2,000 crores got subscription of close to 12,000 crores, and that will see some buying coming in as a proportionate weightage. I mean, depends on how much the retail book gets filled as well. But once that closes, there'll be some buying that comes into those stocks, and there could be some preempting of that. And last but not the least, just looking at the technical factors, HPCL is not present in the Bharat 22 ETF, yes, but BPCL and HPCL are both bouncing off their 100-day moving averages, and maybe there's some bit of technical factor as well out there. So one key reason why OMCs could be doing well, but aside of that, yeah, the market under a lot of pressure.
All right, Neeraj, thanks so much for that. That's the broader markets. Remember, we finished off the earnings season, at least for the Nifty 50 companies. All of them have reported their quarterly numbers. So we're trying to get a sense of how many meet, how many beat, and how many were in line with expectations. Darshan is standing by with the overall analysis. Darshan.
So overall, it's been a decent quarter because if you're looking at the numbers that were strong, 16 came out with strong numbers. The yellow one, that is this part, is the meet estimates, and 10 were actually weak. So overall, in the second half of the earnings season, I think the number of companies which reported strong numbers managed to pick up. So auto as a pack did well, cement did well, on the oil space not so much. You had Tech Mahindra from, so it's all varied. Couple of pharma companies there. Basically, the banks were in line with what the estimates were, and metal as a sector was rather weak. So individually, let's take some of them and we can give an indication of what exactly happened. So just look at this. So the number of, this was 2 quarters ago, the number of strong has actually moved from 23 down to 13 and up to 16. The number of weak earnings have gone down. So from 12, it went up to 19 and it's come down. And what has been most is that from 15 to 24, the number of inline. So if you combine this, it's a decent number, and the number of weak earnings have gone down significantly. Individually, let's take a look at it. Auto companies, one of the best performing quarters in the recent past. All the four-wheelers did extremely well. So you had your Maruti as well as M&M and Tata Motors, all of them gave strong numbers. In the two-wheelers, Bajaj Auto was outperforming while Hero and Eicher met the estimates. So auto as a pack did extremely well. The other sector that we need to focus on is the cement company. Ultratech and ACC performed better than Ambuja. ACC is no longer part of the Nifty, but if you take a comparison, yes, it was an inline quarter for Ambuja, and it's the fourth straight quarter for a strong number by Ultratech. So Ultratech by far is the best cement company. For construction company, L&T gave in a very strong quarter, but the order inflow guidance was disappointing, and that is why the counter did manage to correct. The other one is the consumer companies, Asian Paints, HUL, ITC, all of them meets estimates as far as numbers were concerned, volume growth was concerned, commentary was concerned. Utilities also muted set of numbers, NTPC and Power Grid met estimates, no surprises, management commentary was also the same. Now, oil and gas muted quarter for Reliance after 2 strong quarters. The only big positive that came in for Reliance was that Jio turned a bit positive, and that was something that helped the counter rally. GIL was the only oil and gas company which came out with strong set of numbers. ONG disappointed, the oil marketing companies disappointed. So that's the broad consensus for oil and gas companies. For bank, private sector banks met estimates, weak quarter for Axis Bank on the financial front as well as asset quality. Yes Bank came out with strong numbers, but asset quality was the big worry for Yes Bank. As far as SBI, only PSU in the Nifty, one of the best numbers among private sector banks as well as public sector banks, came out with strong set of numbers. Slippages also came in much lower. For NBFCs, the new entrant was Bajaj Finance, met estimate. Indiabulls Housing Finance came out with strong set of numbers, while HDFC met estimate. So it was a decent quarter for NBFCs also. As far as IT is concerned, all the 4 big companies met estimates. Guidance remained a concern. Tech Mahindra, which is the 5th largest company, came out with strong set of numbers. As far as media is concerned, Zee is the only one. Strong set of numbers by Zee Entertainment this time around. For pharma companies, Sun and Lupin met estimates. Dr. Reddy, Cipla and Aurobindo came out with strong set of numbers. But for Dr. Reddy and Aurobindo, the commentary was not the best that you could have. As far as the agri company is concerned, UPL is the only one which came out with weak set of numbers. The other one will be pretty much the metal counters. Vedanta and Hindalco met estimates. Tata Steel was weak, and Coal India again for the 5th straight quarter, weak set of numbers. And finally for telecom companies, 2nd straight quarter of strong growth for Bharti Airtel. Bharti Infratel met estimates. So overall, if you're looking at the numbers that came out, it's not a bad picture that you are seeing, but a lot of companies came out with inline set of numbers this time.
All right, thanks so much for that, Darshan. That's the analysis, but what's the view on the road ahead? Suhas Harinarayan of JM Financial does not expect corporate India to meet consensus estimates for the full year. In a conversation with Bloomberg Quint earlier today, he explains the rationale behind this call, suggesting that if the first half has been relatively tepid, making up that road in the second half will be tough.
When I look through for all the companies, including Tata Motors and financials, it's still a minus 4% YOY for first half PAT.
Wow.
This is not for, just to a disclaimer, this is not for the Nifty or for the market. This is for a basket of companies, about 100 plus companies that we cover.
Yeah.
Okay.
Would this largely be by market cap, I would imagine?
Oh yeah, these are the larger ones.
Yeah.
I think maybe today's the 15th, so maybe a few companies are left, but I think,
Sure.
about 120 odd companies.
So you said -4?
-4 for the first half.
So -4%, so 4% contraction in profits year on year for the first half.
Correct. And when I look through, excluding Tata Motors and private and the financial space, it's about +1%. It's almost flat. What it means for the second half?
Yeah, what's the ask there?
Yeah, the second half ask is, when I look through consensus, I think consensus is still looking at like a mid-teen kind of profit growth for the full year. So, which will again be trimmed, but I think I won't blame anyone for this. I think the issue is that since demonetization, I think it's been a tough task to just predict numbers. It's been Q3, Q4, Q1, Q2. Again, Q3 this year, I think it'll be extremely difficult to forecast numbers. But the second half ask is clearly a lot higher. And I think if you were to look at a simple 15-16% full year growth, and first half has been -4, you're looking at something like 35% YOY growth in second half. Difficult, obviously.
So what would you trim it down to?
I think analysts are still working through the numbers, but I don't want to say anything before that, but I think it could come down to close to a high single-digit kind of number is my expectation at this point in time.
Okay, that was earnings. Let's talk about pharma. Two of the country's biggest drug makers are Sun Pharma and Lupin are under the weather. Sun Pharma is one of the top losers on the Nifty after its profits almost halved in the second quarter. The bigger concern is that the management was unable to give any definite timelines on resolving regulatory issues at its facility at Halol. Lupin, on the other hand, also is under pressure after the FDA issued a warning over repeated quality violations. To discuss what's going on in the increasing regulatory cloud over Indian pharma industry, we're joined by an in-house expert, Darshan Mehta. Sujay Shetty of PwC will join us on the phone line. Thank you both for joining in. Darshan, let's start with Sun Pharma. We've seen, this is not the first time. They've been under pressure for a while. What's going on with Sun Pharma in specific?
See, in Sun Pharma, the biggest problem started, when everything was going right. Their problem started when they got, out of the blue, they got an import alert for their Karkhadi plant. This is around 3 years ago or 4 years ago. From there, they haven't been able to do much. Then came their biggest plant, that is Halol, under the US FDA inspection. And for the past few years, they have not been able to get it. So what has happened is when Halol was your biggest plant that you were catering to the US markets, that got under an 483 and that got converted into a warning letter. That means your future approvals did not come in. So that is where, their US business got significantly impacted. So that was the story with Sun Pharma. Obviously, they acquired Ranbaxy. So a lot of Ranbaxy plants also, which were under import alert, came to them. So there were regulatory issues there also. They managed to clear Mohali. They got a EIR for their Dadra plant, which is their own plant, which is the second largest. But the biggest concern is that, they're not able to get Halol right. Every quarter on quarter, they say that we are calling. There was an re-inspection for Halol also. Post that also, they were not able to get it right. So that seems to be the concern. In the conference call, what Dilip Sanghvi said is that we don't have any update on Halol. They're saying, they themselves say that, till the time the audit is complete, we don't expect any approvals to come in. They're planning to shift some products that they've been doing it, but there's no clear timeline. So probably in the next 1 or 2 quarters, they will. They have said that they've asked the US FDA to re-inspect it. So once that happens, that's basically the problem for Sun Pharma. The guidance was maintained, but they still say that we maintain a guidance, but keep in mind, and he said that keep that in mind that the environment in US is extremely challenging right now. So that's what even in terms of financials, in terms of regulatory, it seems it's not working for Sun Pharma currently.
Hold the thought. Let me just get in Sujay Shetty from PwC on this conversation as well. Sujay, thank you for joining us. I want to ask you. We've seen this story play out for the last 6-8 months, or perhaps a year, with the top drug makers in this country being being pulled up by the US FDA. Is this a case of where the regulator is tightening scrutiny, or is there a serious quality issue with the Indian pharma industry?
Yeah, thank you, Asha. To answer your question, this is obviously the FDA tightening its scrutiny over the time period that this has been going on. As you'll expect, I won't be able to comment on companies in particular, but generally, if you see the direction over the last couple of years, it has moved from data integrity to more and more focus on manufacturing. Looking more closely at the way companies do as they write and write as they do, to put it simplistically, looking at their capabilities, looking at the way that they answer problems and how sustainable and how global those solutions are. So in a way, it's FDA tightening its scrutiny, and there is a little bit of a catch-up that's going on. The Indian companies that we observe are spending a lot of money both on culture, on training, on CapEx, but it will take time as companies become more mature and more evolved in their response. Okay,
one thing that got my attention, Sujay, is the tone and the language of these alerts. They've progressively gotten a lot harsher, specifically with respect to Lupin, Darshan. Why don't you talk us through what the latest alert has been?
See, for Lupin, what had happened was, in post the earnings call, the management had said that they expect their 2 biggest plants for the US market, that is Indore and Goa, to get an EIR soon. What happened was that they actually got a warning letter. That was the big shocker that came in. So the management held the conference call saying that there were 2 issues. One of them was the out of specification issues, and secondly was the whole time that they're there. So there was no data integrity issue, but and it was a combined warning letter for both the plants, for Indore and as well as Goa. So they are saying that they are looking at hiring consultants to get this done. What happened overnight yesterday was that US FDA, this is a timeline in which they upload. So letter that they had spoken about, they had it, no one else had it. Now the entire world has seen it. It's out in the public. So what came out in the letter was exactly what they said. So they didn't lie about anything. But the problem was that if you look at closely in the letter, they have said that there are repeat observations. So the FDA says that, we've been telling you time and again that, certain observations have to improve it. But again, in the inspections that follow, you keep on doing the same mistakes. So there are repeat observations. And I spoke to some experts also, some analysts also, in terms of what this could mean. So they are saying that, in terms of repeat observation, now the timeline probably will get elongated. Probably it will take anywhere between 12 to 15 months for Lupin to get their act right together for the FDA to come back and clear the plant. So that's where the problem is. And again, like Sun Pharma, they will not be getting any approvals from there. So when your existing products are fine, but when you can't grow, because your new approvals can't come in, how will you grow? That's the problem for Lupin also.
Correct. That's exactly the question I wanted to ask Sujay as well. I know, Sujay, you're restricted by not being able to talk about Sun or Lupin in specific. But broadly, if on one hand your existing facilities are under question and are being questioned in these harshest terms, what do you do for new approvals? Your business growth is at stake, isn't it?
It is, because the US is a big portion of major companies' businesses. It's the big size. So you're right. I mean, when it gets to warning letters, your on-market products are fine, but you don't get fresh approvals. So there is, all of that cap on growth. And then if you go ahead and get import alert, then it gets even worse. Companies typically, they like I said, it is in some senses a catch-up game as well. In some cases, they feel they've done enough. Maybe, the articulation of that or that strategy with the FDA has not gone well for them. So there are various stages of maturity, Harsha. There is no answer to this. Quality is paramount, and you just have to keep plugging away. Till such a time the FDA is satisfied and you have them, broadly in their comfort zone. I think until that doesn't happen, it is just a process of constantly, undergoing improvements to result to the satisfaction of the FDA.
Okay. I just have one final question, and this is with respect to what's going on in the generic industry globally. In the United States, you are seeing prices correct significantly. They're progressively getting lower. Does this structurally change the industry as a whole, or do you see this as a near-term blip?
No, it's not a near-term blip. I think this is, something significant and transformational is underfoot. Many of our top companies are transforming into a specialty model. That's a very expensive game. Not all will be successful. The capital requirements are absolutely humongous. The classical model of the Para 4 opportunities, the first to file have all but dwindled. So, and that combined with the, as you are well aware of, the distributor consolidation in the US has imposed new level of pricing pressures. So, the hunt is on among the top ones to be successful in the so-called specialty space, which is your Derma, your Opta, Respi. But these assets are very, very hard to come by or are excessively overvalued. So I think over the next 4 or 5 years, you will see in our top companies, different models evolve in response to this. So it's not a blip, but a trend that's underway in terms of transformation of the US businesses.
All right, Sujay, we'll leave it that. Many thanks indeed for joining us. Sujay Shetty, partner from PwC, with his views on what is going on in the pharma industry. The interesting bit, Darshan, is if I can just get the Sun Pharma stock for you. We were just talking about it. Dilip Shangvi, Ira, was considered the richest man on the Bloomberg Billionaire Index last year, has lost about $1.5 billion in personal net worth year to date. $1.4 billion to be precise. That stock, the left-hand corner spike that you're seeing, was close to about 1100, 1150 odd, if I'm not wrong. Is now trading at about 500 rupees.
40%.
Yeah, that's the story of Sun Pharma as a representative of the largest company. But that's the story of what's going on in the pharma space.
All right, there's a lot going on in the healthcare space as well, and just bringing you a snippet of news that came in earlier today. Fortis Healthcare has offered to buy all assets of its Singapore-listed trust, which is the RHT Health Trust, for $711 million. Fortis will acquire all of RHT's Indian subsidiaries, a 49% interest in Fortis Hospital, and the entire asset portfolio of RHT. This includes clinic and hospitals in India. RHT jumped as much as 19% in Singapore trading. That's the most since it was listed 5 years ago. Not clear exactly what the objective behind this is. Perhaps the restructuring and the simplification of holdings across the group is continuing. The promoters, remember, are slightly stressed across some of their other businesses, so maybe it has some linkage to that, but that's entirely speculative.
Okay, from pharma to IT now. A lot has been said about the headwinds that the Indian technology companies are facing abroad. A report put out by Gartner shows the domestic market, particularly the government spending, is all set to post some healthy growth numbers over the next couple of years. Love for gadgets particularly is going to be driving that spending. IT services is also expected to be in the high teens. Joining us now is Vice President of Gartner India and one of the authors of the report, Ganesh Ramurthy. Ganesh, thank you so much for joining us. What is your forecast for IT spending particularly in the government sector, and what are you basing your forecast on?
Pleasure to be here today. So at this point in time, what we are expecting for the growth for Indian IT services market is roughly about 9.2% there. We're looking at the market reaching at about 87.1 billion in 2018. The growth really is going to be coming in from enterprise spending in renewing their core infrastructure. We've been talking about digitalization, we've been talking about IoT, we've been talking about a whole bunch of these emerging technologies. But companies, as they realize that for them to be going on and adopting these emerging technologies, they really need to be renewing their core infrastructure, which means they're going to be talking about investing more in mobility initiatives, they're going to be investing more in analytics, they're going to be investing more in cloud, they're going to be investing more in IT/OT integration. So these are all definitely clearly areas where there's going to be spending coming in the next couple of years. And government also, I think, is going to be driving quite a bit of this growth that we are expecting with all the programs and initiatives that are coming under the Digital India umbrella, the Skill India, and Startup India, and all of those activities. These are also kind of driving a whole bunch of enthusiasm in the government ministries and in public sector organizations as well, I would say.
Good afternoon, sir. Just, so within the spenders in India, which are the industries which are spending the most? I saw some notice talking about the financial services sector, which is making the transition into digital quite quickly, and the spending is coming very heavily from there.
I would definitely agree with that. BFSI, being the forerunners in technology adoption, have always been very eager to kind of adopt onto all of these emerging technologies. So the spending there, from their perspective, is definitely going to be slightly more higher than the rest of the industries, I'd say.
Okay. You did allude to the government programs of Digital India, Make in India, and so on. Is that translating into higher spends? Specifically on IT services, on communication services. Are you seeing that blip at all, Ganesh?
I'm not so sure if it is necessarily going to translate into a much higher spend. Probably not in the communication services areas at this point in time, because the network is getting rolled out in various different ways, and there is at least a 3 to 4 year cycle before any organization thinks about revamping or rolling out new networks there. But definitely from an IT services perspective, given all the digitization and digitalization move in the ministries and departments, various different organizations and agencies are considering at this point in time how to go about doing a whole bunch of these digitization activity, and that should definitely be kind of contributing to the growth, I'd say.
Your report also says that once the digital revenues for a sector top 20%, it's transformative in nature. Can you explain to us what you mean by that?
So what we mean there is the 20% mark is a kind of a tipping point. If you see the traditional, I wouldn't say necessarily traditional, if you see the online commerce, e-commerce kind of segments there, companies which have been thriving on these sectors have continuously invested in these digital technologies. And when they start spending that much amount of money, and when they are trying to reach out to their customers and generating revenue from these segments using digital channels, when that revenue reaches that 20% tipping point level, I don't think they will not be really be able to kind of roll back any of those initiatives, even if they think of doing it. So what we are saying is, the moment you start generating those 20% of revenues, 20% of spending that we're talking about, you are going to be in a kind of a situation where you'll have to continue investing more and more and carry forward the entire digitalization transformation journey then. Okay.
Ganesh, I have one final question very quickly. Who stands to benefit by this increase in spending? Is this the large IT players who likely to benefit, or are the smaller guys also, will they get a piece of the pie?
Necessarily the large IT players, because large IT players are not so very nimble than the smaller ones. And I definitely sense a kind of a wind in the government space and in the public sector organizations that they would like their suppliers, their organizations to be more agile, nimble, and flexible, which the large organizations really pretty much struggle with about. So I do see the smaller organizations benefiting by this growth as well.
Ganesh, thank you so much indeed for joining us. That's a view from Gartner. This is an interesting one. If the government spending is going up, then the vertical growth for some of the IT companies from government will also go up. So net it's a positive. The larger guys, as Ganesh points out, perhaps will stand to gain a little more.
Absolutely, that's the government sort of private sector dynamic there. We'll slip into a quick break. On that note, we'll come back, talk markets, talk currencies, talk commodities. Frank Benzira of Societe Generale will join us in a minute or two. Welcome back. You're watching Power Lunch. Let's take a look at the headlines at the Harper. Indian markets trade lower for the third straight day, the Nifty hovering around its 50-day moving average.
Oil prices fall after the International Energy Agency cuts its forecast for demand and cautions that the global market will remain oversupplied.
Tata Steel, the Piramal Group and Edelweiss ARC are likely to submit final resolution plans for Electrosteels. That's a Bloomberg Quint exclusive.
Okay, let's take a quick check on how the markets are faring at this point in time. Pradeep is taking a look at some of those stocks that have been moving. Pradeep.
So markets are clearly kind of oversold, but there is no reason really that traders can find to get in and start buying. Rather, there are some more triggers on the downside, like you just mentioned. Commodity prices have seen heavy sell-off yesterday as well as today, and the result is stocks like Vedanta, Hindalco, and the entire metal pack is really dragging the index down. Then again, Sun Pharma has disappointed the investors a bit with the kind of outlook and guidance they have given. So that stock and the sector is also getting affected. You also have heavyweight like ITC coming down. And look at it, even in mid-cap space, some of the stocks which are closely linked with metal and commodities, like the graphite electrode makers, Graphite India and HEG, they have also fallen, were closing close to the trading close to the lower circuit. In fact, it continues to trade at the lower circuit level. Both these stocks, as you can see right now. So there is this renewed pressure on some select pockets in the market. On the positive side, you do have good numbers from Shreyas Shipping or a stock like Fortis Healthcare that gave some that made some announcement about a likely acquisition. So these few stocks have moved up, but net there is pressure that continues to be there.
All right, what about the commodity markets? Pradeep, there's been some action there, oil, but also metals overnight?
So that is where it all kind of started, maybe even for the equity markets. Had commodity markets not corrected yesterday and today, maybe equities would have bounced back, at least in India. So the correction was probably triggered by the Chinese data, but traders and the analysts we have spoken to so far also suggest that the correction was kind of expected for a while. We have seen a significant run-up, and therefore the correction might actually be healthy. So there could be further downside to the metals as well as the oil. Focus is more on oil because the kind of forecast that the International Energy Agency has given, they are talking about a surplus in the current quarter and also the next quarter, that is Jan, Feb, March. That is in spite of the fact that the compliance with the within the oil producers, both OPEC and non-OPEC, has gone up quite a bit. For the full year, it's around 85%, but for the October, as the IEA report mentions, the compliance is at around 96%. But despite this production cut, the oil market will probably remain in surplus because they have cut down the expected demand by around 100,000 barrels per day for this year as well as next year. Although they are expecting a positive growth in demand, definitely 1.6% for the current year and 1.3% for the next year. But they think markets are tight, but not tight enough to kind of sustain the higher levels that we have seen.
Okay, in fact, let's listen to Fatih Birol of the International Energy Agency talking exactly what Pradeep was mentioning. The shale boom in the United States is also going to be adding to this, and his outlook on global demand-supply dynamics.
Let's say in the next 10 years or so, U.S. total oil production will reach about 17 million barrels per day. And as such, there will be a big difference between the United States and the second biggest producer. And what we also see is that in the next 10 years, more than 80% of the global oil production growth comes from United States only. As such, we believe there will be a lot of oil in the markets and will put downward pressure on the prices. And in terms of natural gas, it is the same story, a similar story. The gas production, shale production in the United States will increase substantially. And again, in 10 years of time, the difference between US and Russia will be more than 30%. US will produce more than 30% gas than Russia, and lots of LNG exports will come to markets and redefine the global gas markets operations and the prices as well. So a big upheaval in the oil and gas markets driven by the shale boom in the United States.
All right, now oil may be seeing a little bit of a correction, and the long view on oil may not be that damaging, but the significant jump over the past few months has certainly added to India's external sector woes. I'm referring here to the trade deficit data that came in yesterday. You got a $14 billion trade deficit for the month of October. That is the highest that we have seen since November of 2014. A bunch of factors playing into that, but let's start with the export front, because the exports contracted for the first time in many months, almost 15 months, and that was worrying. We've spoken to people since then, and most seem to feel that the correction was, a reaction to the excess or the steep jump in exports that we had seen in the previous months. A lot of exporters seem to have front-loaded shipments because the duty drawback scheme was coming to an end in September, and they wanted to get their shipments out while they could still avail of that scheme, following which there has been a fall in exports in the month of October. The problem is that given all the disruptions due to GST, etc., that have happened, it's very tough to understand what is the steady state of growth in exports that perhaps will only come through in a couple of months or so. On the import front, just one more chart that I want to bring up. This has been a slightly diverse situation. Firstly, gold imports, which had been elevated through parts of the year for various reasons, have actually started to normalize a little bit, not on a year-on-year basis, but certainly you're not seeing the kind of surge that you had seen in the past. But you have seen oil imports start to pick up. The non-oil, non-gold import segment, actually growth in that segment was down to about 5%, which is good news because in the previous months, that segment of imports had seen a sharp jump, and some economists, Shajit Chinoy, JP Morgan in particular, were wondering whether that links into supply disruptions once again due to GST, which means that people are importing what they were earlier procuring domestically. So, Harsha, that's sort of the structure of the data. But again, I repeat myself, it's very difficult to understand what the steady state on this data is. There are too many sort of noisy factors playing into it.
But wasn't the market anticipating this number anyway, or has it
not
been surprised? Not this large. There was supposed to be a gap, but it was not supposed to be this large.
It was not supposed to be this large. And I think for one reason or another, the trade deficit number has remained elevated through this year. So, I mean, it's not a worry. As I said, economists we spoke to said that the current account deficit would probably be between 1.5 to a little bit higher than that of GDP. So at the current account deficit level, it's not going to be a huge concern. Up till about 2% of GDP, you're comfortable. But still, the fact that you're having a trade deficit which is widening, and it's widening because of various factors. Exports, if they don't strengthen after a couple of months of disruption, will be a worry. Remember, this is a period of time where exports across most other Asian economies have actually strengthened because the global economy is doing better than it has in years. So if India misses this export bus, I think that's something to be worried about. And of course, the oil import story will play out along with prices. And the last thing we read right now, both from a current account and a fiscal perspective, is higher oil prices.
Okay, so how is all of this playing on the rupee? The rupee has not reacted dramatically to the trade data. The currency, in fact, has traded flat against the US dollar today. But what is the currency traders worried is the surge in oil prices. Strategists, global forex strategists, are advocating selling the rupee and buying the Malaysian ringgit instead. Shubhadeep Sarkar of Bloomberg News now joins us to explain that rationale. You've been speaking to a couple of currency strategists across Asian markets. What's the sense you're getting, Shubhadeep?
That's right, Harsha. We spoke to a whole host of currency strategists across Asia to get a sense of purely how the crude oil price hike may play out on currencies. We are looking at clearly rupee being a sell here. I mean, obviously the main reason for that would be India's current account deficit is a current account deficit nation. So basically the rupee and the Philippine peso are the two currencies which strategists are looking at to sell. While obviously Malaysian ringgit is on the opposite end of the spectrum because they're one of the surplus beneficiaries of the oil price hike. So clearly it's one end of the spectrum. You have the Malaysian ringgit, on the other end you have the Indian rupee and probably the Philippine peso. Peso again, interestingly, Philippines is also gradually turned into a current account deficit country this year. It used to be a surplus country, so there is pressure on the finances of Philippines also.
But are the voices to sell the rupee increasing on the street right now?
Yeah, it's not necessarily a full sell yet for the rupee, but gradually, I mean, people are relooking at the forecast. We had a Credit Suisse yesterday revising their 3-month and 12-month outlook downwards from 60. The 3-month outlook was revised downwards to 65 from 62. So basically, people are relooking at how the currency plays out. Remember, it's a kind of a double whammy for the currency. I mean, it's on one hand you have the current account deficit, roughly a $10 increase in oil prices would work out to a 0.4% widening of the current account deficit. Then you have it playing out through the inflation route, which again has a fiscal implications. So it's kind of a double whammy for the rupees. So basically, strategists are keeping a close eye basically on how the crude oil price sustains. I mean, if it goes above $70 and sustains, then that's a serious concern. Now we are seeing it's still in the early 60s, still in the comfort zone. But we need to see how the price sustains or not.
On a lighter note, guys, I mean, so if equity market strategists get their forecasts wrong, I think currency market strategists are even worse. I don't think I've seen 1 year in which currency forecasts have actually come through correctly. But thanks, Shivadeep, for joining us. Speaking of oil prices and the turning environment, both on the bond side, perhaps on the equity side, certainly on the commodity side, joining us to talk about some of this is Frank Benzimra, cross-asset strategist and head of Asia Equity Strategy at Societe Generale. Frank, very good afternoon to you. Thanks so much for taking the time to speak with us. I'm just going to pick up on a conversation we were having, and that is, the changing scenario on crude oil prices, what it means for some of these Asian markets, particularly markets like India, which are importers of oil. Any thoughts on whether you think this level of oil prices sustains and hence the view on these markets changes a little bit?
Well, first of all, we have to look at what the positioning is on the oil market today. And when you look at the positioning, you can see that a lot of hedge fund, a lot of real money is having some very long position on oil. And this is, in our view, rather limiting the upside that we could see on the oil price. So we have a forecast which is more in the range of 60 in a 12-month time than to see another increase in the price of oil. So now, having said that, you have some risk that the oil could increase very sharply because of some Middle East escalation, for instance. And in that case, some market and some countries would be more impacted than others. Globally, Asia is a net importer of oil, with some countries like Korea and India, which are net importers. So if we see the price of oil rising, then all the issue around the current account deficit and worsening of the current account deficit would be raised again.
Okay, just hold the thought, Frank, just for a moment. There's just news coming up on your screen at this point in time. The Oil Ministry has enforced BS6 norms to be rolled out in New Delhi. This is the government's efforts to combat pollution. We don't know the details of what this really means, but these new norms are going to be introduced. That's advancing BS6 fuel norms to combat pollution. It's only advancing. This is not a refresh. This is going to be advanced to April 2018. That's all I could catch off the screen. But Frank, coming back to what you're pointing about oil prices, what are the implications on currency? We were just having a conversation about how most currency strategists are now perhaps looking at the Malaysian ringgit. Would you review how the Asian currencies are positioned given the context of rising oil prices?
No. At the moment, we are not reviewing our view. We tend to like the high-yielding currency. So the Indian rupee actually is one of the currencies that we like, even if we find it a little bit overvalued. But when we think in terms of a total return, this remain an attractive currency. So the discrimination that we are making in terms of currency is not that much between oil sensitive and the non-oil sensitive, but it is more in terms of whether they are high yielding or low yielding. So we tend to prefer the Indonesian rupiah and the Indian rupee in the context of Asia.
On the equity side, Frank, how would you look at the Indian markets now? I mean, like all other markets, we're very close to record highs. That doesn't seem to deter fund flows, at least yet.
Yes, so a lot of markets are at their historical high. This year has been a very good year for global equity, and they have been a very good year for some reason. You have some earnings recovery, you have some valuation which is still okay, and you have plenty of liquidity. Now, if you look at the specific case of India today, we have some valuation which is starting to be a little bit stretched, and you have some earnings which are not really recovering. So especially on the private investment side, very low earnings growth. And this is where, tactically speaking, over the last 2 quarters, we have taken a little bit more cautious view on the Indian market. It remains one of our, let's say, a big strategic buy on the long term. But on the shorter term, on the 3 to next 6 months, we are going to be a little bit more cautious because we find that there are some more interesting stories, and especially on the earnings recovery when it comes to the equity market elsewhere in Asia.
Okay, so if you're looking...
Actually, no. Yeah.
Sorry, please go ahead. Finish your point.
India is India is a very interesting market because you remember a couple of years ago when you had a lot of concern on growth. When you had some risk of hard landing in China, when Brazil was into a recession, when Russia was into a deep recession, then you had, in terms of growth, you had one bright spot, which was India. So you could see that actually the world was slowing, but India was growing, and so you could see a lot of foreign money which was actually pouring into the Indian market. And now what we see is that we have a kind of a global recovery with a lot of emerging markets which are growing again at a time when we see some slowdown on the Indian market. So the attraction that some foreign investor could have on the kind of a unique place in the world where you have such a high growth is today question. But
Frank,
as I said, it's more for us. It's more a tactical view.
Okay, Frank, we'll leave it there. Thank you so much indeed for joining us. That's a view from Hong Kong. Well, let's get back home. The going is getting tougher for Reliance Communications. The NCLAT has today issued another notice to the debt-trapped telecom operator after Manipal Technologies moved the appellate tribunal, claiming that RCom owes the company 2.7 crore for biometric fingerprint scanners. The next hearing has been scheduled on the 4th of December.
All right, staying with debt-trapped companies, the race for stressed assets is getting hotter. Well, not exactly how I would describe it, but 3 companies are in the fray for debt-laden Electrosteels Steels. This is to submit the resolution plan for Electrosteels Steels, which is under the insolvency process. Vishwanath Nair is joining us with the details on that. Vishwanath, what do we have?
Yeah, so what we understand from the people involved in the system is that there are 3 companies. Piramal Group, who has an arrangement with Bain for stressed asset investments. There's Edelweiss ARC, who has been pretty active in the whole NCLAT cases and bidding for them in that segment, and Tata Steel, which has been interested in Electrosteel for a while now. I mean, in 2015, when the lenders first had invoked the strategic debt restructuring in Electrosteels Steels, still since that time, Tata Steel has been eyeing these assets, has been trying to buy this company, but there were some concerns with the valuation, there were some concerns with how much of a haircut the lenders would have to take, and they ended up not taking it back then. But now that the NCLT process process is on, and bankers are trying to find new buyers for the company. Tata Steel is back in the race, or that's how we understand it. At this point in time, they're still figuring out some of the key data points within the company so that they can firm a bid. They can present a resolution plan to the committee of creditors, who will then take a call on who is the most eligible of these three potential buyers.
So we're going to see a lot of cases now start to come up to this stage, right? Because that 270-day deadline will start to come up soon for a lot of them.
So a lot towards the end of December and somewhat sometime in January, a lot of these cases will start to see closer to that 270-day deadline. So there has to be a call that has to be taken in these cases as to whether these companies will be sold to somebody, whether there's a chance that there's a chance of recovery, or if we just let it be and let it go into liquidation. So that is a call that the lenders will be taking over the next 2 or 3 months, and that will keep emerging as time goes by.
And 270 days is the deadline imposed by the IBC. Just guys, Vishnath, stay with us. Speaking about banking, just we finished off an earnings season, not talking about banking earnings per se, but looking at the cumulative amount of gross NPAs. If you pull up that chart, it's an interesting chart because it's showing some flattening out in the NPA picture. So that is the chart which takes you back 8 quarters, because that's when the asset quality review happened. So from 3.4 lakh crore of gross NPAs on the listed bank segment, you have now gone to 8.4 lakh crore. So that's a 5 lakh crore jump. But if you look at the gradation, Harsha, you had far steeper increases at the early part of the cycle, and the 1.3% increase that we have seen between the June and the September quarters is the lowest over these 8 quarters. Vishnath, there are a couple of risk factors, and from your interactions with bankers over the earnings season, what was the sense you got? Because there is still those divergences which may get accounted for, plus there are these restructured accounts, RCOMs, SDR accounts, which may eventually come into NPA.
That's true. So talking about the divergences specifically, so larger banks like an SBI and ICICI are still yet to report any kind of divergence, because either their assessment was not over or their conversation with the regulator was pending. So we will see some of that in the third quarter. There will also be additional provisioning required for the second list of NCLT cases, which will start coming up in December. Some lenders have front-loaded some part of these provisions, but there will be quite a bit coming in. Most of them haven't. Apart from that, there's also companies like RCOM who have not been featured in any of these two lists, but are stress companies very clearly. The discussions with the lenders have been going on. By December they have to convert debt into equity in RCOM at least, and if they fail to do so, then the SDR falls through, and then eventually what is going to happen is the company is going to turn into an NPA, and banks will have to start providing for it as though they were NPA back in June 2017. So that's additional provisioning.
So provisioning pressure could stay, and that flattening out may not actually play out over the next couple of quarters. Harsha.
Well, one very quick question though. From whatever you've heard of the bankers in this quarter, apart from what is known and what we've discussed quite a bit about divergence, the watch lists, is that reposing confidence that things are getting better or not?
I think Vishnath's better placed, but I don't think so.
No, not at all. See, case in point, Axis Bank, right? So they have been repeatedly refreshing that watch list. They've been trying to. So what that shows essentially is that what they thought would be the risk factor on their book is probably not that. It's probably plus 15% or plus 20%.
And we don't know how much that number is.
Exactly. So that number keeps coming up over the next couple of quarters, and then we'll know.
Every quarter it changes, and a large percentage of these watch lists are slipping. I don't even know what the point is.
Exactly. So a lot of them actually given up. For example, ICICI Bank has completely given up the watch list. SBI stopped announcing it because now they have additional watch lists from their associate banks which have merged. So it makes no sense to look at these numbers. They keep changing every quarter.
Moving target. Vishnath, thanks so much for that. That's the banking space.
Okay, let's talk about auto now. The news flash is on your screen. Auto emissions norms have been advanced in Delhi. The Petroleum Ministry has decided to bring in the Bharat State 6 norms as early as April 2018. Yatin is standing by to tell us why this is significant, what it means for auto companies and what it means for oil marketing companies. Yatin.
Well, Harsha, what I understand from the news flash is that this is only relating to the fuel norm. So we have BS 6 compliant fuel which needs to be marketed in the new capital region and Delhi. Basically, this norm was supposed to get rolled out in April 2020, but they have preponed it by almost 2 years now to almost April 2018, which means almost from a year and a half from today, we'll have Delhi, wherein the oil marketing companies need to supply BS6 fuel, at their petrol stations and diesel stations. Now, what this means for auto companies is that, from the next 1.5 to 2 years, they will have to probably start rolling out BS6 compliant engines, but does not mean that the existing portfolio goes for a toss. This is more to do with the oil marketing companies and their capex, because BS6 fuel means that the emission has to be quite limited. The sulfur content in gasoline has to be lower versus what they market currently. So it's more to do with the oil marketing companies, which need to gear up as far as their refining capacities are concerned. Probably they will have to incur additional capex before they could actually think about. So the capex for oil marketing companies should increase in the short term, so that they are able to process a fuel which is BS6 compliant. So this is more to do with the oil marketing companies. Not a major setback for the auto companies. Probably we'll have auto companies talking about modification in the engine, but oil marketing companies is where bulk of the capex will have to be done to meet these BS6 norms.
Yathin, thank you so much for that. That's on the auto emission norms. Here's the deal story. At least 2 foreign private equity firms are eyeing a stake in Indian insurer Royal Sundaram General Insurance Company. Bloomberg's George Smith Alexander now joins us on the phone line. George, thank you so much for joining in. What do we know? Who are the bidders?
So we know that there has been a host of bidders which have been attracted to the sale of Royal Sundaram General Insurance. These are just initial stages. The first round of bids have not yet been decided. The dates have not yet been decided. So as of now, we know that Apex and Carlyle are there, and there are a host of other international private equity companies which are also there in the fray.
Okay. Just from a valuation standpoint, George, if you could sort of reiterate what kind of values are we talking about?
So for the 49% stake, we are looking at anywhere around $500 million. So I guess what has happened is with ICICI Lombard's listing, valuation which analysts earlier thought about has been substantially, so the sector has been substantially re-rated at this point of time. So everyone, it seems to be wanting to have make use of that.
Okay. Very quickly, we've seen quite a bit of deal making happening in the financial space this year, haven't it? I mean, is there more on the anvil? Is there a value that you can peg on that?
So if you look at it in the financial space, when you say deal making, it would be a mix of IPOs and other stuff. Just on the IPOs, there has been a host of the insurance IPOs which have come up, be it ICICI Lombard, or be it New India and SBI Life, and a host of them. So obviously what is happening is a re-rating of the entire insurance sector has happened on one side. On the other side, we also saw what could have been a merger of IDFC, but obviously the deal fell through. So obviously then that would also mean that there could be something which could be there or which could come up. So this is a sector which is thriving at this point of time.
George, we leave it there. Thank you so much indeed for joining us. George Smith Alexander talking about a potential deal at Royal Sundaram. 2 guys of Evans Interests, Apex and Carlyle.
That's a Bloomberg News exclusive. Before we close off the show, here's a picture actually which speaks 1,000 words. We don't really need to talk over it, but we will in any case. That picture is telling you or mapping the farmlands across the world. This map was released by the US Geological Survey, and it shows that India has more farmland than any other country in the world, even more than the US and more than the China. The new study was aimed at improving food and water security, and it says that global cropland now totals 1.87 billion hectares. This is about 15 to 20% higher than earlier estimates. The earlier estimates had perhaps fallen short due to inaccurate mapping, but India is the greenest of the lot in terms of countries out there on that map.
Contrast that, the amount of greenery that we're seeing, contrast that with the pollution that we're seeing in north of India.
That's
and
true.
That tells you a story.
That is true. That is true. We're just managing it badly, perhaps.
Out of time on the show. Thank you so much for watching.